The FENG was formulated approximately 20 years ago as a forum to help senior finance executives network and also provide them with technical education. So tonight we'll be joined by several speakers who will introduce themselves just for, to save time. And we'll be discussing current trends in mergers, acquisitions, and divestiture in the oil and gas business. And introducing our first speaker, Mr. Jesse Thompson, Senior Economist with the Federal Reserve. Thank you.
Good evening, everybody. So I'm going to set the table here with a sort of current economic conditions in the energy space. We're focusing on the United States. When I was asked exactly what it was that we were going to talk about with respect to energy, is it upstream, midstream, downstream? The reply was yes. And so I will do my best in the next 10, 15 minutes to do that. Of course, I have to tell you all, as usual, that my opinions are mine and mine alone and not necessarily representative of the views of the Federal Reserve Board of Governors, bank presidents, officers, or anyone else associated with the Federal Reserve Bank in any way, shape, or form. Of course, with the disclaimer out of the way, I'd always open my presentations with a bit of an ask, and that is that if you or your firm or your clients or your friend, whomever, is active in a business decision-making capacity, and the Federal Reserve should hear from them. You think they've got a good perspective, you think you've got a good perspective. We want to hear from you. We want to hear from businesses. The feedback that we get from real professionals reacting in real time to economic stimuli, to prices and sales and contracts, oftentimes will give us a much clearer picture of what is going on well in advance of the economic data. And during the pandemic, this was made explicitly, very clear by how early businesses saw the inflation compared to the inflation data and macroeconomic modeling. So we really rely on your feedback. It goes to the FOMC at every major interest rate setting debate. So please log on to dallasfed.org and let us know if you're interested in participating in our surveys. You can just Google us and you'll find it real quick. Okay, with that out of the way. So let me get to, this is the obligatory tell you what I'm going to tell you slide. And I've got just a couple of main takeaways. Number one, U.S. oil and gas industry is on firm footing after a stellar recovery from the pandemic. Oil and gas production jobs are steady after a ramp down of activity in 2023. But consolidation is impacting oil field services, margins, and utilization. When you look at the big M&A deals, we asked in our survey what's going on. We're expecting to see more M&A deals through 2025. Large E&Ps are focused on acquisitions amid modest capital spending increases, while small E&Ps are right now focused on production growth or maintaining their current production. Oil prices well above break-evens. U.S. production growth outlook is very modest with everything that I've just said, and that's leaving OPEC Plus in firm control of oil market balances, which you'll see in a bit. And then lastly, we're exporting a ton of natural gas. It looks like we're going to be exporting a ton more natural gas by the end of the decade. And all of that is generating not only, of course, a lot of potential for exports, but a lot of construction jobs between now and 2030. Taken together, the outlook for energy production, processing, and export industries remains optimistic over the next few years. But there are risks. There are on the other hands, and there are shrugging the shoulders. I don't know what's coming next. So digging in. First off, I'm going to focus on the right-hand side here. So what I'm talking about, E&Ps outperformed the S&P 500 in the pandemic recovery, went from one of the worst performing sectors in terms of total returns to one of the best performing sectors, the public sector, and the post-pandemic period. But from late 2022 on, the industry has underperformed the S&P 500 with the exception of refining and marketing. Refiners have done exceptionally well in terms of total returns. They've had very, very strong margins. And although those margins are expected to shrink, they are expected to remain historically very healthy over the next 2 years at least. When you look at this, though, at the bottom end here, if you look at the bottom end of the bottom right-hand side of that chart here, you'll see equipment and services that has really lagged the rest of the sector. This is oil field services companies. And so they really have not performed well. They've not been able to recapture margin. And so they've been sort of very limited in their capital spending and their ability to maintain their fleets and their crews. We've had declining activity. And so it's just been a tougher row to hoe for the equipment services sector. And just lastly, I always like to point out, when you're looking at this chart, I give you this chart mainly to remind everyone that as stellar as the performance was for the oil and gas sector post-pandemic, public sector total returns was, relative to the opportunity cost of being in the oil and gas space over the last 10 years has been very, very high. So I'm an economist. I focus on a lot of jobs, and when you look at U.S. oil and gas jobs, they plateaued late last year. Now, drilling activity, number of frac fleets that were deployed, number of wells being completed each month, overall declined in 2023. But we were at a deficit of labor, and so we've hired more and more people. You've got less overtime now. You've idled some crews, but there is not a lot of spare capacity in the oil field space. That total employment stack has now leveled off. If I were to sum all of these jobs up that are directly in the oil and gas space, we're looking at a labor footprint that is very close to where we were in about 2006, 2007. Just to give you an idea of just how productive these new breed of skilled workmen are in the oil and gas space. We're producing 13 million barrels a day of crude. So with all of this going on, with their labor footprints and returns kind of going sideways for the last bit, large firms, we asked them, what are you focused on for your primary goal for 2024? We asked this at the very end of December 2023. Large firms are focused on acquisitions and reducing debt. You can see they're on the left-hand side of the chart. And smaller firms, they're focused on maintaining or growing production. In fact, some argue in the comments that part of the reason for growing production is really about tapping a few extra wells so that they can, as a part of a bid to sell their actual assets, because big companies are looking to buy. And when we ask them, do you expect more deals of $50 billion or more to occur in 2024 and 2025? The industry overwhelmingly said yes. There's more M&A coming. Very large deals are coming in the next couple of years. The economics look, at least to the people on the inside, overwhelmingly like there's bigger deals. There are many big deals yet to be had. Now, I'm shifting here from that type of survey question. I'm going to be moving more a bit into the outlook. Oil field inflation plateaued really in late 2022, and we've held the line on inflation since then. Oil prices, of course, have skyrocketed relative to the break-even prices, which you can see our survey break-even prices are detailed there in the green and black dots from the Kansas City Fed survey and the Dallas Fed survey. And then I have a PPI index, a producer price index for oil and gas, also on the chart there, just kind of showing you how it tracks. And then you can see oil prices are well in excess of the break-even prices. So overall, when we ask them, hey, here's where your costs are, here's where oil prices are, what are you budgeting for in 2024? Not what do you think the oil price is really going to be. I mean, I have that in here, but what really matters for us is what are you budgeting for? They're budgeting for WTI in the low 70s in 2024. That's what they're budgeting for. And we asked them, okay, but what do you realistically expect to get for your oil in 2024? Overwhelmingly, the answers were in the higher 70s, just shy of 80. It was about $78. Now, the dispersion was wider for the what do you expect versus what are you budgeting for. But nonetheless, about high 70s is what they were expecting. And I say this because there's been a consistent pattern here the last year, not really since the pandemic, and that is if oil prices are substantially above where our break-evens are, we will, through our variable dividends, we will give out better dividends. And if oil prices substantially fall, well, then we're apt to buy back stock because our stock, that'll be a more cost-effective way to increase investor returns. And with break-evens, even with break-evens at 64, it would take a substantial, based off of feedback from comments that we've gotten from industry, a more substantial decline than say into the low 60s to cause a major decline in drilling activity. So, and why is all this happening? Is because of that earlier slide that I showed you, where they went for a long period of not making money, and after many hard lessons have discovered that they prefer generally to be profitable. which is a novel thing for some people in their careers in this industry. So all that together, you take our forecast at the Dallas Fed, you lump it together with a bunch of other people's forecasts for US production growth. We're slowing down from about 1 million barrels per day, fourth quarter to fourth quarter last year, to about 0.24. Actually, now it's going to be a little bit closer to 0.3 million barrels per day, fourth quarter to fourth quarter. I think that's going to get ticked up a little bit. So fourth quarter to fourth quarter. And then if you look at in 2025, more of the same. So slow and steady growth, because that is what the companies are promising us. And when you look at the breakdown of whose costs are what, who's got pricing power, who's got the best acreage, the independent producers simply do not have the capacity. The oil field service providers don't have the capacity to provide a major ramp up of activity, even with oil prices really, really high. Even if every signal was saying drill, baby, drill, it's just going to take a long time to deploy a substantial number of a substantially larger number of rigs or frac fleets. We don't have the equipment, we don't have the crews, and we have some spare capacity, but not a lot. So this looks locked in. Knock on wood. It's famous last words for anyone in the oil and gas industry, right? So world oil consumption. I'm going to turn now to the macro market. Do we believe this outlook? World oil consumption is going to log healthy growth through 2025 based off of an average of many different forecasts for global consumption, not just the EIA or the IEA. So very healthy consumption growth over the next 2 years is expected, and it's expected to be met by non-OPEC production growth, particularly non-US. The US is part of it, but also we're seeing a lot of barrels come on from Brazil and Guyana and West Africa and other places as well, and that's meeting it. On balance, when we said, all right, well, production consumption, what is the consensus view on balances? And the consensus view is that the global market is going to stay balanced between now and the end of 2025, more or less, with a softer 2025, more surpluses, more overproduction in 2025. Under the assumption that Saudi Arabia in particular, but OPEC more broadly, brings back their production in 2025. So OPEC Plus is responsible for balancing the market at this point. Now, you might look at that and say, the market is balanced, Jesse. Why are oil prices going up so much this year? And the big reason seems to be geopolitical risk, which I'll just touch on a bit in the risk section at the end, if I have time. 21% of US natural gas currently is exported. 21% of everything we produce is exported. By the end of 2025, it's going to be about 24.5%. And it's going to be pushing 26% if the EIA's projections for domestic production are right. We'll be pushing 26% by the end of the decade. We're currently exporting about 12.9 BCF a day. That's going to rise by at least 11 BCF a day of natural gas exports by 2028 if everything is done on schedule. This is not affected by the LNG permitting pause. This stuff is getting built at this point, no matter what. That ship has sailed. Where the pause really becomes relevant is if you're thinking about production or you're thinking about exports or new export capacity in 2030, 2031, 2032, later on. And the pause, in order for the pause to affect that, it has to stay in place for over a year. So the LNG export boom that is going on is going to continue for the remainder throughout much of the remainder of the decade. The question for us here, does it affect our producers? How does that affect us as consumers here at home? Is between now and 2030, I think the bigger question as far as the domestic economic effect is, do we build the pipelines between the resource and the coast? That's what matters. Do we build the pipelines between West Texas and the Texas Gulf Coast, between northern Louisiana and the Louisiana coast? We're just writing off that we're going to get any pipelines built in the Northeast. Those are the both intrastate pipelines. Those are probably going to get built. And so long as they get built, and so long as we continue to build that capacity, it is hard to imagine a scenario where we cannot export as much LNG as we want. Up until the point where we crush the price of natural gas globally down to Henry Hub plus cost. At which point, that last LNG investor will lose a lot of money. But everybody else, up until that point, will be doing fine. pardon me. Some last considerations. So warm weather and robust supply have left natural gas prices extremely low, and they're currently negative out in West Texas. This represents downside risk to the outlook for gas-heavy firms. We are seeing some likely shut-ins and laydowns of rigs in relation to this, and we are hearing that there's some deferring of wells being completed even in the oil and gas space. Because if you have a relatively gassy well, and if you can wait a few more weeks, maybe you'll get a little bit better dollar value for your production and for your NGLs too. Geopolitical uncertainty and risk is affecting oil prices, but the impact risk to the physical market seems marginal or temporary for now. What does that mean? All right, so Israel, Iran, Gaza. At this point, it doesn't look like, it seems low probability, and when we ask experts, it seems low probability that that is going to drive a major physical disruption of supplies. And so much of the run-up in price in response to that is really more of a geopolitical risk premium. It is not a physical thing. And so its ability to keep prices high is questionable. Just depends on how the geopolitics unfold. When you think about Russia, they have some refinery outages. It's not clear how long they're going to last. It's not clear that they're going to get back up and running. And they are talking about cuts, and we'll see how long those cuts go. This is a more tangible thing, but at this point, it still looks marginal to the overall global demand, supply and demand outlook. So with these considerations, the outlook for U.S. energy production, processing, and export industries remains optimistic over the next few years. And just because I'm a local guy, I will say that's going to supply a modest tailwind, but a steady tailwind to the broader Texas economy. And in fact, I think really on the heavy and civil construction side, we'll see a lot of benefits to the regional economy from all of this because, as has been the case for the past several years, every single molecule we pull up out of the ground has to go on a boat. There's just nothing else to do with it. If it doesn't go on a boat, it doesn't get produced. And I will cede the floor.
Yeah, thank you so much, Jesse. For those of y'all that do not introduce myself, my name's Ray Trevino. I'm with Pecos Country operating out of the Fort Worth area. We are a family office, and we've been in the exploration and production industry, goodness, now going on about a total of 30 years. Jesse, I cannot thank you enough for coming out today and sharing with us everything that you got going on. I do want to say that I do got to ask, you show that the global warming, the higher temperatures are a reason why the natural gas prices are going to stay low this year.
Well, yeah.
Is there any effect of the fact that we're still continuing to produce so much oil in West Texas that as long as we continue to produce that much, that the LNG will stay low as well?
Absolutely. So the bulk of our U.S. natural gas production growth is coming from associated gas production. It's not from on-purpose gas production. So where the warm weather has come in is that basically we burn a lot of natural gas to stay warm in the winter. And if you don't have a winter, then you come into the spring, you got a lot of excess natural gas on hand relative to what you might be used to. This has been a boon to Europe, who is gas supply starved post the Russia-Ukraine thing. But overall, that is where the warmer weather has really hit nothing. Now, if the weather gets warm enough, then we're all running our ACs like crazy, and you gotta get in the power of the grid. You gotta burn natural gas when the demand gets super high. So that could be a summertime benefit.
I appreciate that. And again, thank you very much for coming. Before we move on to Chris, does anybody else have any questions for Jesse at this time? And y'all could definitely go back to him as well at any time. Anybody?
Yeah, Jesse, I got a quick question. You mentioned the LNG pause. You said a year from now we'll see impacts. Are you talking about a year from the initial pause or a year from today, or?
So if the pause is sustained for over a year, then it would start to have a material effect on projects, because the project pipeline takes several years to get through. I mean, it's at least 3 years to even get through permitting for the site, let alone everything else. So that would push back if you were thinking, I'm going to get in the permitting pipeline now, and I'm going to turn on a new facility in 2029. If this pause goes long enough, well, then maybe you're pushing that back to 2030, 2031. In the meantime, In the meantime, the people who are building the regasification plants on the other side of that transaction are thinking to themselves, well, maybe I can't rely, I need to get my secure, my funding, my long-term contracts. I'm going to go to Qatar, or I'm going to go to Australia, or I'm going to go somewhere else to get that supply so that I can get my construction done on my schedule. That's really another risk. So by the time all this irons out, it's hard to know how much excess LNG demand there will be to supply, but there's no reason why we couldn't supply.
And that's Chris Hosek with Texas Star Alliance. And will you introduce yourself as you ask your question?
Well, my name is Tiffany Sands. I am a lawyer. I have my own law firm. I started in Chevron and oil and gas, but I just had a quick question for you. In terms of the LNG facilities that are located here, like the Pascagoula facility, not necessarily here, but here in the United States, are we seeing a greater increase of people retrofitting now? Because I know like that facility was initially just an import facility, and then they went through this whole process of retrofitting themselves to become an export facility. And so are we having more of that now to be able to deal with our LNG issues?
So that has been ongoing. At the moment that shale production proved, so when shale gas came on, it was like, hey, we're going to produce lots of natural gas. They didn't realize that they would completely destroy the economics of their own business model by overproducing so much natural gas that there would be physically not enough room in our country to consume it or store it. And so, yes, all of those import facilities, they should all have been converted by now if they haven't already been. They're doing nothing if they're not converted to exporting something else.
Got it. Thank you.
Does anybody in another room or online have a question for Jesse?
Bueller?
Can everybody hear us out there? Yeah.
Yes, we can hear you. Would anybody like to unmute themselves and ask a question?
Okay.
I joined late, so if Jesse wants to reiterate whatever he was talking about, that's fine. If not, we can move forward.
We'll move on.
Next up is my good friend and the guy that's fighting for our industry all the time, Chris Hosek with the Texas Star Alliance.
Oh, well, thank you. I appreciate that. And Jesse, that's a great lead into what I was thinking about when you said how Shell, the destruction that Shell created. I started at the Railroad Commission in 2005. I was there when Shell took off. And actually one of my first duties or one of the activities I did was we were creating an LNG import facility along the coast here in Texas. And then at the same time, I was being briefed on what the Newark Barnett Shell was. And I remember thinking to myself, being a layman, I was like, somebody's got to be wrong here. I mean, we got all this gas in Fort Worth we're drilling. Why do we need to import? And it turns out we did know who was wrong. It was the LNG import facility. Since then, that's been transitioned. Worked at the commission. And for those of you who don't know, the Railroad Commission should be called the Oil and Gas Commission of Texas. It's a longer story why we're called the Railroad Commission. But we don't do anything with trains or anything like that. Even my mother's still confused about that. And that was 15 years ago. But I worked there about 6 years. Really saw the rise of shale, saw the need for these mid-size E&Ps to have representation. Started my own lobby firm. Now I have about a dozen oil and gas clients and heavily involved in Texas politics, DC politics, and the impact and convergence of public policy with elections. So, obviously we all know in this room, Texas is the largest producer of oil in the country and natural gas. So what we do in Texas matters, and especially when you look at other states and where we see actually a movement to slow production, Texas is going to become more and more important. And it's really amazing when I sit on some of my client calls and I hear states gleefully talk about how they're shutting in or closing in oil and gas production. I just think that's a very interesting perspective to take in this day and age. So when we take a look at Texas, what we see and what I really focus on is our regulatory body, which they're elected statewide. We have 3 railroad commissioners. They're each elected every 6 years. What we like to see is consistency in the Railroad Commission. Currently up right now, we have Christy Craddock. She has been there for 12 years. She's elected to a 6-year cycle, and she recently won the primary. So if she were to finish her term, she will have served in office for 18 years. It's pretty amazing. Currently in Texas, every elected official in the state is every statewide elected official, excuse me, is a Republican. I don't necessarily see that changing in the future. I think regardless what happens at the presidential level, I think the momentum, at least in this state, is still on the Republican side. When we talk about energy in general, we can talk about traditional oil and gas, or we can talk about renewables. I think this last session, we saw the legislature turn away from renewables. If you were to look at our incentive bills that we passed, we had to reauthorize a business incentive package, and renewables were specifically let out of that. One of the major arguments we did hear during that kind of debate was that the federal government passed a pretty significant incentive package that these renewables could play off of. But as far as Texas right now, there's no incentive package at the state level when it comes to any type of renewable project. What was kind of interesting, I think, to this last session, we saw the rise of a lot of interest in geothermal. There was a lot of legislation around that. I think that's a very interesting technology. I'm no expert by any means. A lot of my clients were looking at that and following that. But I would say the number one topic that we're looking at in Texas, and we'll look at it again next year, is CO2 sequestration and storage and usage all around the coast. I mean, this is a big push by, every major, every refiner. I mean, it's a big project. There's a lot of policy areas we need to clear up and clarify before we can truly move forward. I think you can look around the coast and see smaller projects being developed, which I find fascinating and interesting. But to kind of get the larger scale projects, we're going to have to see a little bit more clarification and kind of poor ownership, kind of what a project we call integration, prorationing, bringing other landowners in. And then, those are really the two I see a lot of challenges with. But we had ran a couple of bills last session. They were unsuccessful. We plan on taking another look at it again this session. For those of you who don't know, in Texas, our legislature meets once every 2 years for 6 months, and it's in every odd year. So we'll be meeting in 2025, so a little bit from a year from now. So looking forward, to getting back into that whole process. In the meantime, I know everybody's asking, well, what do you guys do for the other 16 months or whatever? What they do, what do we call interim studies? The House issues interim studies, and we look at all the different policy aspects, and so does the Senate. The Senate recently just introduced theirs. Interestingly enough, CO2 study was not in there. What was interesting in there was a lot of electrical issues. And one other point I like to pass it, before I know we're running a little behind, but just want to touch on this a little bit. Electrical production obviously is a big issue in the state the last 2 years. And I think Jesse touched on it just a little bit. Now, natural gas will benefit the state. The state last year passed a couple incentive packages to encourage dispatchable generation. And I think you saw LCRA just make a major announcement utilizing some of those funds to build a peaker plant kind of in the central Texas area. So interesting movement forward in that electrical space. And I think with that, I'll just answer any questions.
Guys, real quick, again, Chris is out there every day fighting and really understands the for good, bad, or indifferent, understands the game very well. So if anybody has any questions from a left, right, or any type of question, please don't hesitate to ask.
Good, bad, or indifferent? What kind of How about for good? Listen, no, I'm teasing. Yeah, politics sometimes gets a little sketchy to talk about, but I can take it if anybody has any questions.
I have a question.
Sure.
So my name is Anne-Marie Mwachi. I'm a nurse, and I'm invited by Mr. Goswell. So I'm glad to be part of you. And this is my husband, Mr. Andy, and he's into oil and gas. So that's what we're doing. So my question is basically about talked about electricity and what is going on. And I know I've seen so many adverts coming up asking people to kind of divert to solar energy and stuff, and the state government is kind of subsidizing that. And the last speaker spoke about the gas industry, what is going on and what we are expecting in the next 2 to 3 years. So how do we balance between what we are expecting for the people in the market how do they want to balance between what we're expecting in the next 2 years in the gas industry and people trying to deviate into solar energy production for electricity?
Right, that's a good question. I get that a lot. I think it's the all the above approach, right? We need, at least in Texas, we need all forms of electrical generation right now. And I think we're starting to see them. A lot of people don't know Texas is the largest wind producer in the United States and actually in the world. If you were to look at it, it's pretty amazing where we sit. And projects have been built and they're going to be sustained as much as they can, but especially with federal subsidies. I think you're going to see some interesting solar projects come online too. These were all kind of pre-incentive package ending for the renewable energy, at least in Texas. So it's yet to be seen on how that's going to impact the direction of electrical production. But to answer your question, I'm going to take the political answer and just say, yes, all the above. I mean, what do you expect from a lobbyist to say? That's how I'd answer that. Jesse may have some thoughts.
Yeah, as you said, we are the largest provider of wind by far, and that makes us by far the largest producer of renewable energy in the United States. If you limit it to wind and solar, we're the largest producer. If you look at solar power, Texas is getting I think some significantly more utility scale solar power than California over the next several years. We're going to overtake them as the #1 producer of installed utility scale. It's an important caveat, utility scale solar power.
A lot of people from California moved to Texas within the past 2 to 5. So I think that just makes sense on the energy level. Probably y'all can figure out the numbers.
Absolutely. In-migration to Texas has definitely been driving power demand. We've seen a huge influx from both East Coast, West Coast, and the Gulf Coast. So Louisiana, we've gotten a lot of people, as you might have noticed from the proliferation of Cajun food. To our benefit, we're beating Dallas and Austin area in that regard. So yeah, we are seeing a huge increase of solar investment in Texas over the next several years. And a significant increase actually this year and next year in battery. So we're actually going to be recruiting a significant amount, like several gigawatts of battery capacity on our grid that will compete with peaker plants to sell power, to buy power when it's super cheap.
Solar energy. I mean, I think it makes sense here. It makes sense to have solar here because it is Texas and we run at hundreds of degree heat. But it's expensive to implement solar, and it's expensive to implement all these country people who are used to trying to do shit themselves. Sorry for my language, but like when you're dealing with a lot of people who try to do it themselves, because this is fucking Texas, it makes sense for solar. I mean, it makes sense ideally if you can talk people here into it. Yeah. It makes sense. It's cost efficient. It helps the world run, but I mean, it's hard to talk people into it.
We know that solar is a very good choice. If we can just get it affordable.
My background is economics, so I deal with helping to present data that executives can use to make fairly significant decisions. So I've worked in West Africa, the Permian Basin, West Texas being big. I was doing some of that early on when they were first starting to try to discover how to make the shale work, and they've done a pretty good job of doing that over the last several years, even since I've left. They're still doing well, even after I've left. So it looks like it's still going through. I've worked in Latin America, all over the world. So what I would like to, I'm going to dive a little bit deeper into some of the stuff that I have presented to executives at various oil companies and helping them to understand how value is created, how to improve the value, and how to determine what approaches they should take, whether to divest, whether to acquire, whether to expand in other areas of in the oil and gas space. So my work is primarily in oil and gas. I have
Try to make it bigger.
Oh, it's
Oh,
okay, there we go. Okay, all right. Okay, so the value chain. So we look from a decision-making standpoint and a valuation perspective, all of these aspects from reserves to drilling and production to processing, storage, getting the product from the source to the consumer, the refinery processed chemicals that are byproducts of the hydrocarbon system, as well as the marketing of those hydrocarbons, all have a role in the valuation throughout the energy sector. Let me just kind of go through a process. I'm like I said, I've been in the industry for at least 40 years now. It looks like, counting the numbers here. And so I can tell you back when I first started looking at economics in the late 90s, and we were talking about pricing, commodity pricing. I can tell you that in '99, the Brent was at 1985, right under $20. Henry Hub was at about $2.27 at the average price for 1999. So if we were doing an economic analysis back then, looking at those two products, Brent and Henry Hub, this is what a curve would look like, right? I mean, this is how, and this is so, going out into 20 years from that point, getting up to $30 a barrel was probably outlandish, right? We were probably thinking, oh man, this will never happen. And so we had never seen 30 before. So this is what happened over the intervening 5 years up to 2004. So we started seeing that the price we had assumed for Brent was much lower, or was much higher than our estimate. So any projects that you had brought forward during that period of time was understating the results for that particular time. So we go back and we look at it. So now we go back to the drawing board again and say, now we've got this thing figured out. We know this price. This is never going to get above $100 a barrel, right? I mean, this is pretty solid information. We've got Henry Hub. We think it can get to 10 because we've been seeing this exuberance at the end of 2004. So we started to see, and then so the Brent was at $38 at the end of 2004. Henry Hub was just under $6. Looks like we may have a good deal going here. Now this is what it's looked like over the last several years. So we have no clue. We significantly overestimated Henry Hub. You can see that how it's going completely to craters here over the last several years. And we've at 2004 basis, we had significantly understated the crude oil price. Although we did see some shocks over the course of that period of time, but it looks like we've gotten that all figured out over the last several years since COVID. And so we can see now that making decisions and trying to value something using commodity price as one of your uncertainties can give you a little bit of a headache. And so we use the expression in the oil industry, we buy high and sell low, which is done. When the price goes high, we start getting a buying frenzy. When the price goes low, everybody's trying to sell everything. So it's not the most intellectually brilliant industry that I was a part of. So now, so what I want to talk about here is uncertainty. So now I'm going to talk about we have to look at drawing uncertainty bands around some of these prices. So I know that helps to improve and increase our reliance on a band of prices as opposed to, and these are, no matter what we try to do, that number is going to be still entirely off the chart. Probably if we look back in 2030, looking back to what we tried to estimate, even as at our high or low, we're probably still off. And so that's kind of the nature of the business. Capital costs the same thing. This is Sarah's 2000 base. During that same period that the crude oil price was going up significantly, we saw that the capital costs were going up by significant amounts as well. So if you were gleefully excited about the crude oil price going up, you probably weren't so happy about the price of drilling rigs, facility costs. Steel was going up at a pretty significant rate as well during that time. So that impacted your ability to generate commercial rates of return. So some of the questions we want to ask before we begin the process of, especially if you're talking about dealing with an international environment. When I say international, for those of you who are not in the U.S., I'm talking about anywhere outside of the U.S. So who's providing the investment capital? Is it going to be the investors? Is it going to be the state? And how are revenues and profits shared between investors and the government? So this is a typical map of, for those of you who are in the industry, probably have seen this before if you've done anything related to fiscal activity or negotiated with the state. They're basically two different systems. There's a royalty tax system, and then you got a contractual system. The U.S. has a royalty tax system. If you have federal lands, Gulf of Mexico, it's a royalty tax system. We pay a bonus at the beginning, and then we pay the government royalty off the revenue, and we pay taxes on the profits. The contractual system is mostly what you're going to see outside of the U.S., unless it's some unique system that they're trying to develop to attract foreign investors. You can either have service contracts or you're going to have a production sharing contract. And the difference between them is how you're going to book the revenues or book the reserves. With royalty tax, you do get to book the reserves. Production sharing contracts, you can book the reserves if you're getting the oil in kind. In service contracts, same thing. You can book the reserves if you're selling in kind. In most cases, you're getting cash, so there are no reserves that you can book. Saudi Arabia, Iraq, most of those are service contracts. West Africa, mostly going to be production sharing contracts. Indonesia, same thing. So these are the differences between the three in terms of how they differ. The legal title for the royalty taxes is in the hands of the investor. They have they own the equipment, they own the reserves. They just pay the tax. At PSC, once you build it, it transfers title to the state. So they own it. They pay you a cost all to recover the cost. You can recover your cost, but at the end of the process, that equipment transfers over to the government. In service contracts, there's no title transfer. It's always going to be with the government. And this is kind of a system, and this kind of explains why price doesn't always matter. This is what a typical contract looks like for an oil and gas system. You have costs, and then you have government take, which is going to be in the form of either taxes or some profit oil or what have you. And then you have what's left over is the contractor take, or profit in this case. The example to the right shows why, in some cases, in some governments, if you don't understand the fiscal terms, you can get really screwed because they may have an indexing system. So this is sort of like the Indonesians or the Egyptians have this system, and I've used this in West Africa as well, where if the price is over a certain amount, most of that increase goes to the state. So you have to have a fairly good understanding of how that oil and all that profit is being distributed before you determine whether or not those barrels are efficient or economic for your development. So it's kind of remind you about the pricing, the costs going up. Just because the oil price went up significantly, the cost went up significantly. So you still had some economic distress, and we had projects that had at the beginning, when they first were sanctioned, were very economic, and when after the price started going up, they weren't able to recover those costs.
So, Michael, we're going to cut you short there, but a number of people have asked for your presentation. So
Okay.
We'll make sure that we get it shared with them. And thank you very much.
Okay.
So next we're going to have Godswill and Bob Gay from Otos going over 3 companies and taking a look at M&A using the Otos platform. So Bob, thank you. Thank you, Ray.
Yeah, I'm here.
Okay, wonderful.
Do you want me to capture the screen?
If you can stop sharing your screen. There we go. Okay, wonderful. Thank you.
So are everybody looking at Marathon Oil here?
Perfect. Yes. So we have Bob Gay with Otos and Godswill Blanco, CEO of Betterford.
Did you want to do an intro, Goswell, or do you want me to just take off?
Just take off, please.
I just take
Okay.
off.
Okay, good. Okay, good. So Otis is a machine learning entity that extracts line items from financial statements that appear for U.S. companies as they file their filings once a quarter with the SEC. And it takes those line items and it sums them up to make a series of performance metrics that we're, I think, going to find, most of which are familiar to us, but help us to identify the trend direction in growth and financial condition. The data that comes off the income statement is primarily focused on the DuPont model, which is sales growth, gross profit margins, SG&A expenses, operating costs, and taxes. And then from the cash flow statement, we get capital expenditures, we get non-cash costs, and we get how the company's financing the difference between their internally generated cash flow and their cash flow requirements for capital expenditures and other decisions. And so what I do for convenience is display all of those factors in this money tree avatar. And the money tree avatar just displays for each company or for each index what's happening to those performance metrics. And so if we look at, I just run this animation again. I'm not going to use the animation very much, but I do want you to see it. And what we've seen from Marathon Oil is that sales growth has been high, but then it fell fell again with a big steep decline, gross profit margins down, operating profit margins down, everything looking very sad here. And here's the index of the share price of Marathon Oil relative to the S&P 500, and a display of what we call the dominant factor, in this case, capital expenditures. And so what we're interested in is to identify those factors where we have usually fairly long-term history. Marathon Oil's probably got a 30-year history on Otis, is that we're able to not only measure what the trend direction of those performance metrics are, but we're also able to, and this is important, also able to measure how highly correlated they are, how reliable they are, how usable they are in getting at the forecast that we're trying to make. My typical forecast is I try to forecast the stock price, but there's not a big difference in using corporate accounting data to forecast the stock price and using corporate accounting data to forecast the commodity price. In this case, the price of oil. And so what we'll do is to just take a look at the at those components of that avatar, which I'll just remind you again are the DuPont model to measure the trend direction of growth, and capital expenditures and borrowing to represent the trend direction of capex and financing. And then we calculate the degree of correlation that each factor has with the historical performance of the share price. And so cash from operations ROI, which is the globe of the tree, in the case of Marathon Oil, has been 80% correlated with the direction of the share price with a 1-quarter lead. Well, you don't get a more powerful variable than that. I mean, that's astonishing that it could be that high, and then on top of it give you a quarterly lead. What we're interested in doing is sort of picking the bottom, right? We're looking for what's the point at which oil prices will change direction and then be sustainable in a new direction. Well, that has to do with the capital expenditure cycle. The capital expenditure cycle is a measure of capex relative to sales, and the Marathon Oil example is not a bad one. So here we are drawing the picture of the performance of Marathon Oil. You can see it performed exceedingly badly from 2012 until the teeth of the financial crisis, the teeth of the virus crisis here in 2020. The share price declined by about 80%. And then bouncing out of the negative virus wave, we sort of got a recovery bounce, and that caused the share price of Murphy Oil to increase by about 400%, about 5 times the market. And you can see that the degree of reliability of capital expenditures in predicting the direction of the share price is fairly high. And in this case, we're really using the share price as a proxy for the oil price. When it's not a bad proxy, if you look at price of energy stocks compared to the price of energy, they track each other pretty well. But what this is showing now is that after a few years of overinvesting in capital expenditures and causing the oil price to be under pressure as supply growth is higher than demand growth, we've seen our first quarter's evidence that that's turned around. So capital expenditures relative to sales are on an uptick trend, or likely to drive the share price higher at Murphy Oil for the first time in about 2 years. And over that 2-year period, the share price of Murphy Oil has been decently volatile, but generally on a downtrend. And so what we're attempting to do here is, by using the capital expenditure cycle in context of with the growth cycle, we're able to identify that evidence that the company has moved into an acceleration phase. And this uptick in capital expenditures last quarter was our first evidence that Marathon, at least, is moving into the acceleration phase of the share price in this case. And of course, we're using the share price as a proxy for the commodity price. And so that's why as we see this evolving in the larger and larger number of U.S. energy companies, there's a better chance that we are in a sustained and strong advance in the price of energy over the next couple of years. I also wanted to show you what Exxon Mobil looks like. Was there something you wanted to ask me, Godswill?
Oh, yeah. Well, so I was curious about, you talk about the supply growth and the demand growth as index to CAPEX. Can you shed more light a little bit on how that's able to give us an idea of what the bottom is?
Yes, and so if basically the question is about the capital expenditure cycle. So as companies ramp up their capital expenditures, they're typically doing it in response to a higher commodity price. And we've had conversations earlier in this talk about the impact of the commodity price on investing activity. So investing activity gets induced up by the increase in commodity prices. And that increase in capital expenditures, of course, with a lag, produces an increase in supply growth. And that lag is uncertain and variable. But we heard a little bit earlier that it would be typically around 3 years from concept to execution. So that's a long lead time. And so once that capital expenditure trend begins to become positive, the likelihood is that supply is going to outpace demand as these new projects associated with these capital expenditures begin to come on stream over the next couple of years in response to that uptick. Well, of course, as soon as that extra capacity comes on stream, then you've got supply growth faster than demand growth, and as a result, there's downward pressure on prices. And the effect of
sorry to interrupt you, Bob, but just to kind of keep along with time, we're going to introduce our next speaker, Adriana Sauceda from Moss Adams, and she's a business valuations expert.
Thank you. I don't have any slides, so
Perfect.
no worries for me. So I thought about speaking about renewables today because I figure everybody here was going to talk about like the big oil and gas transactions we had last year, which I'm surprised nobody has mentioned the Chevron and the Exxon Mobil yet. I thought that was going to be kind of the focus, but why talk about renewables, right? We had peak demand for oil and we're expecting demand to continue to increase. So when and how is renewables going to become more important? Well, the timing is still kind of unclear, but we can expect this to be the next energy revolution. Goldman Sachs predicts the size and the scale of renewables is going to be twice as big as the shale fracking revolution. So that's the magnitude it's going to have. We're just entering the early stages of it. So that's why it's important to talk about it. So what happened in the M&A space in renewables? It was not a very good year. We had a decrease in the number of deals and the value of these deals, as well as the amount invested into private equity markets in renewables. We kind of went backwards globally. The M&A activity decreased, but it was seen more significant in the US, where we had the M&A levels were even lower than 2021. So that's a very significant drop. In the public markets, we saw clean energy stocks going down 40–50% in the last year. And this year so far, if you look at clean energy ETFs, they already have double-digit declines so far this year. So why are we seeing this such a negative environment in renewables? Well, a lot of the renewable energies and utilities are very sensitive to interest rates. And as we know, those cuts that we were expecting, not to like point at you, but we were meeting a year ago, everybody had that in mind, and those cuts did not happen. So it created a very difficult environment to raise the capital to build the infrastructure. I think we were chatting about that. So yes, utilities and scaling up renewables requires a lot of money. And even for companies that have good technologies that just need to scale up, they just couldn't secure the capital, and that has delayed a lot of the growth in renewables, and hence the decline we saw in last year and so far this year. So what's the short-term outlook for renewables? I think as long as we have this high interest rate environment and we have this presidential election that's gonna have, uncertainties about changes in legislation. We have that uncertainty and the high interest rate. I think the environment is gonna be negative for renewables in the short term. But I do think there is a lot of positive in the longer term. I think the next 5 to 15 years, we're really gonna start to see those new technologies disrupting the energy space and adding energy from new resources that can be scaled up to meet demand. And they're gonna be reliable, because that's really what we care about, particularly in Texas. We need reliable energy sources. So I think the outlook in the long term is good. And where I specialize is in valuation. So I spend a lot of time looking at risks, because higher the risk, you should be giving your investors a higher return. But with like I said, with high interest rates, it's becoming harder to do that risk return trade-off for investors. So that puts a pressure down in the values of the companies. We also have certain risks that are not government geopolitical, but there are more just due to the nature of the early stages of renewables. They have risk that when they scale up the operations, plans or execution don't go according to plan. So that is the additional risk. What I think needs to happen is these large traditional oil and gas companies that have strong balance sheets and good free cash flow and access to capital, they are the ones that need to come in and help support the growth for the renewable companies, because they're best positioned to do that. It doesn't have to take on all the risk for renewables. It could be via joint venture where you split the risk with other companies, but I think that's going to be the solution to the current problem that renewable energy has. And I actually had a question for everybody here. I saw that ERCOT said, quote, they're changing the grid to meet the power demand that's going to increase in the Permian because operators are going more electric. Confirm or deny?
Yeah, absolutely.
Okay, yeah. So we are dealing with growing pains in the grid where there's a huge lag from developers to be able to access the grid. And while that's happening, we have the battery storage coming online and all of these changes. So I think it's gonna take a little bit of time before we can feel like we have that reliability that we all want.
Most of your E&Ps are building their own infrastructure,
So
tie into the grid. You can't rely on, grid systems are bogged down in regulatory morass and can't.
What you're having in West Texas is you're bringing technologies out there, right?
Yeah.
And so the E&P operators have been given a mixed message.
Yeah.
Everyone's been told electrify. Okay, we've electrified. Now, wait a minute. Now we're going to start cutting you off and push you off the grid. Now you need to be able to measure how much electricity you're using. So that's where, we're bringing out, more digital technologies to do this, right? Yeah. But, you need kind of consistency and policy and action, right? Just because the amount of capital you have to have out there just to run operation. Yeah. That's just from my perspective.
Yeah. What they're doing is you used to run diesel generators, a mixture of natural gas and diesel generators to power the rigs. And when those rigs are really pulling, they're lifting that load, they're pulling enough power a small city. So they still have to supplement that, but they've tied into the grid so that when they're doing just kind of day-to-day operations, they can run off of the grid and not have to have those generators running. And by burning less diesel, you get a green stamp.
Thank you.
Yeah. But it's very challenging, difficult to do that and be able to balance the power properly.
Oh, this is absolute. Hi, this is Stu Turley. I'm not sure if you can hear me or not. Great points on the renewable. Take a look at Saudi Aramco and Saudi Arabia. They are funding a lot of the renewable through hydrogen through the profits of oil and gas. And you mentioned the electrification of the fleets in the Permian. I bear with me. I'm going with a great question here. With the electrification, I visit with a lot of CEOs, and small modular nuclear reactors are actually being considered for the frac fleets that are being electrified in the microgrids. Here's where there's a gigantic problem, and this is the ugly baby in the room, and that is the legislation through regulatory actions is hurting not only the renewable sector that is behind the truly behind the high cost of energy in the United States. There's 24,000 renewable energy projects waiting to be put on the grid. And I think it's a good thing. But how do we work with the legislative process to get rid of regulatory actions hampering low cost energy? I haven't really heard any of that. So again, great conversation, guys. But if there's any ideas or feedback on how to do that to lower energy costs, I'd be thrilled.
Yeah, this is Chris Hozick. That's a general question. I think that's a really good question. I think the specifics are what are the regulatory barriers you face? I mean, when you're talking about renewables, these projects trying to get on the grid?
Well, there's two kinds. It's the, like the regulatory issues around oil and gas. We have the methane regulations that have just now come out. And the oil and gas companies are going to have to absolutely quantify their methane that is being released and the cost for those regulations on methane alone, on saying, hey, we're either going to do CO2 or anything else, is going to drive the oil and gas price through the roof. I hope that helped.
Yeah, I'm sorry, are you saying you're concerned about the methane rule? It's coming out?
Absolutely. All of those are absolutely, you take a look at scope 1, scope 2, scope 3, you take a look at all this, and it is putting an unfair burden on the oil and gas companies.
Especially the Quad B.
Yeah, I mean, if you're asking me if I agree with you, yeah, I mean, that's what I do for a living. I monitor this. Yeah. So, I mean, look, those are the challenges at the DC level, at the federal level, I mean, that's a whole different political animal to address. And unfortunately, our legislation has evolved now to more through a rulemaking authority at the federal level than a legislative authority. And that, you can point fingers at both sides on why they ended up in the place it did. But, now where we're at, you're gonna have to look at some type of presidential change to modify something like that. That's my take.
One other question though, last question. How do you take that regulatory risk factor into looking at a deal evaluation?
We're going to get to that question shortly. We have one more speaker. We're running slightly over time.
My bad.
No, it's not your fault. It's not your fault. You did nothing wrong. Those of you who wish to alight at 8 o'clock, please do. We're going to continue on for approximately 10 minutes with Amy Henry. Godswill is going to summarize for us. And then we're going to grab one more beverage at the G30 sponsored vodka lounge. Then we're going to leave because the people at the law firm are slightly tired. They've been here for a very long day. And we're going to convene at Reserve 101, where we have some complimentary beef and chicken tacos for you at one of the most famous whiskey bars in the United States, Reserve 101. So we have Amy Henry, a summary, beverages, Reserve 101. Thank you, ladies and gentlemen.
So I'll try to be short and sweet. Presentation going or not. Yeah, it's on there in the laptop.
One on the right.
Yeah, on the one on the right. But as they're getting set up, I think it was good to hear Adriana, right? And I'll just kind of make some comments there as well. So my background, I'm a CPA, a Juris Doctorate in law, but my background is about 30 years with the energy industry. So I started with Shell and Shell Tech Ventures, working mainly on the commercial side. And that's also when we took our unconventional technology out of the lab, and also was with Shell Tech Ventures and Petronas as well. But fast forward, I'm the CEO of Unique Ventures. So think of us as just an extension of the larger energy industry. So we work off of their global technology agenda. We look for technologies around the world. It's in pockets. A lot of it does not come from energy, right? So we're agnostic. It goes from ag tech to biotech, anything of that nature. But we also do the heavy lifting is how do we get these technologies de-risked and re-risked and getting them to that commercialization space. So I'll go back, tie back quickly. I'm going to do probably a lot of this off script, but our concern was, with this big push to decarbonization and climate is I really don't think a lot of these climate VCs and early stage VCs have the sustainability, right? They are not the right holders because it takes 7 to 10 years at least to bring these technologies to life. Let me see. Next slide. Hit the down. Oh, hit down. Okay. I kind of got that one. So if you talk about what industry is focusing right now, besides, typical operational excellence, from your standard, oil field that's looking at hydrogen, CCUS, CCS, there's, hundreds beyond hundreds of projects. The problem with those is you've got different perspectives from entrepreneurs coming up with this technology and what energy companies think that carbon price should be. So it's going to take some time to get the agreement from a market standpoint, but these are not super, I would say, large scale projects yet. So they also have to figure out how do we work with our APCs to bring those costs down when we're dealing with hundreds and hundreds of projects here. Electrification, biochems, SAF, decarbonization kind of things. So that involves in doing this along with industry. We have to work with colleges, government labs, DOD, DOE, incubators, accelerators, trade organizations, professional organizations, angel groups. I also sit on angel groups as well. And then you have a lot of off-grid innovators. Now what Houston has is we've got the magnets to pull this in. And then IRA is increasing that magnet because basically your talent is here. So we got a lot of, typical West Coast, East Coast innovators coming down after they've raised their Series A because the talent is here, the infrastructure is here. They need to be close to their eventual customers. The problem is that Texas or Houston has is we just don't have enough early stage capital. We've got a lot of growth capital, got a lot of private equity. So this is really a question. It's up to Texas to win or lose this at the end of the day, if you ask me point blank. Because I wanted to tie this, I'm going to bypass this to make this kind of fast. If you talk about M&A, but of course, there's been a huge M&A activity in the upstream. The recent one's been SLB, Champion X. We expect the upstream M&A deals just to continue on, just like everyone said in the room. Now, our standpoint is looking at this from technology and innovation. So I see that twofold. When you do these big M&A activities, it slows them down, right? So, you look at Hess and Chevron. Well, that's going to be slowed down a year. Hess was really great at doing a lot of pilots, and they had a really good team. So all of that kind of work of trying new things, doing things in the field, well, that's been kind of put to a halt. But however, with some of these merger or acquisitions, it is a good mesh because they are learning from the different technologies that they were trying. And some of them have already commercialized. And so then they can do it at a larger scale over a larger asset base. So I'm kind of on the fence about how I truly feel where this is going to be. Even globally, if you look at Canada, Canada also has had a lot of global M&A. But what we haven't talked about is brain drain. So Canada has, because of economic policies, and the US is kind of heading towards that way. They're at the lowest level of their entrepreneurs across the board, lowest level in over 20 years. They've lost it. Those entrepreneurs, either they've come down to the US or they're just kind of giving up, or they're leaving and they'll go to Europe or they'll go to the Middle East. So Canada is gonna fix that problem. But before I go into this, you've got, we're focusing a lot also on India and Modi and what he's doing. And the markets are talking more about this as well. And we're also going to have, I'll call a reverse brain drain. So we've had a lot of these innovators come over to the US as part of Innovators for the US, especially in Silicon Valley. So with Modi going warp speed, he's reduced 40,000 regulations. He's got the Japanese building out bullet trains connecting 16 corridors. He's pushing solar policies. So now, and the IRA has slowed down the progress for the US in terms of, you have people doing pilots. Now they need to do full scale projects. India is now opening up that opportunity, right? So we're also going to start to see that talent go over to India as well. But if I look at M&A, since I wanted to tie this some to M&A, we see a lot more. This came from Gartner. AI is being used more and more. If you were at CERAWeek, the theme of the day was talking about digital technologies. So across the board, and the workforce is still a huge issue, both on renewables. You're short by 1 million plus project developers. You're short, a few million on operational people, same way with traditional energy, whether you're upstream, midstream, downstream, right? We've got a huge workforce because right now globally, when IEA did their study, over 50% of the workforce is in Asia. Most people don't realize that for energy. The question is that going to continue? But if I talk about investment, this was last year and there's a lot of dry powder, and that dry powder has continued. So we're even seeing companies that have raised $100 million, right? That may just die off. And then if you look at it, where are the dollars really going to? Even though energy and the climate change and decarbonization is talked, actually the allocation that's going there from the VC community is fairly minimal at the end of the day. And then, the projection on some of the reports that have come out, even from PitchBook, again, Q1 of this year was a new 5-year low for investing into technologies. And then, really the 3 key themes are going to be decarbonization. The markets are changing. It's no longer a straight global market. You've got regional, sub-regional, global, but really companies are going to be really focusing on digitization full time. And so you've got a lot of different challenges: infrastructure readiness, regulatory. These are all these non-technical risks that we all talk about. A lot of these projects, especially on the renewable side, even if you take out the gearing, right, they're sub-economic, and so really those economics have got to get up there before they can go forward. They're just not there yet. And we don't have enough people. So we've got to take the learnings from oil and gas, because we see these new entrepreneurs and these new projects, they're repeating the same historical mistakes our industry has had. We're seeing them, how do they contract with an EPC? They're running into major cost overruns. These are the same things. So they need to make new mistakes, right? Not the same ones from industry. So that there's been this divide between climate tech and traditional oil and gas. But if we don't start getting people to cross the chasm from both sides, it's just not going to go forward, bottom line. And I think I'll keep it up there. And then this is, I just get some headlines, right? Because you've got even the major Wall Street, they're very bullish on India because of the regulations that Modi's, going to do. They're going to be the third world's economy, but they're also focusing on nuclear and SMR technology, right? And so one of Texas's big FDI is India. foreign direct investors and likewise. So I think that's going to be something we're going to be focusing on this next year. Did I do good? I'm done.
Well, thank you, ladies and gentlemen. So Gods will provide a quick overview and summary for us. I know everybody wants to go and grab their final beverage from the vodka lounge and then possibly join us at Reserve 101, which is 1201 something street, Caroline Street.
Caroline.
It's on the flyer. So yeah, thank you for the
So I'm just gonna
summary.
take less than 3 minutes. Everyone here has actually said all that needs to be said. I just had a few notes. Transaction role is very important in M&A as far as we're concerned because it's helping to fund oil and gas projects and is important in providing capital and offering strategic guidance to the sector. Now, this role is very important because driving innovation and growth is what is going to be really necessary in the coming years in oil and gas. And the firms like KKR, Blackstone, Carlyle have made substantial investments in exploration and production infrastructures projects, okay? And this contributes to the sector. But here is the key. The key is that the volatility in the oil prices in 2023 had posed not just a challenge, but also presented opportunities for transactions. And as firms, carefully navigate through price fluctuation and capitalizing on market downturns, they try to acquire distressed assets at attractive valuations, thereby enhancing their portfolio. But the key thing is that the transactions that we witnessed in 2021 and 2022, what about $25 billion from the public markets, it's sort of like a continuation that is spilling over currently. But we've seen a situation where there is oil and gas assets are being transferred from the public market into the private markets, and that is cause for concern because if these assets, they move from industry leaders to industry laggards, issues like emissions can increase transparency, can decrease transparency, and that is why we need industry leaders to take the lead in actually trying to ensure that we keep accountability in terms of emissions and keep regulators out the door. If we're going to have the industry laggards, the small operators, making those acquisitions or making those transactions, we have to charge them to become a little bit more transparent in terms of their emissions, be able to, because we have a situation where the industry is actually struggling with regulatory issues. That is I have a whole lot of presentation I want to present, but I'm going to just keep it short. We have to work on our ESG integration in our operation, because at the end of the day, this ESG integration is shaping our transaction structures, going forward. Because as firms begin to integrate ESG criteria into their investment decisions, these are supposed to be aligning with investors' preferences and contributing to sustainable development goals in the industry. And we have to look at client demand, we have to look at regulations, we have to look at sustainability outcomes, and of course, we have to look at materiality. So these are things that we have to charge our principals and begin to look at going forward. Thank you.
All right, guys, everybody, thank you all very much. Thank everybody out there in the universe. And again, thank you all so much. And thank you, Mark. And thank you, Chris Hosek, for hosting again, and the law firm. Thank you all so much.
Thank you.